Okay, welcome back, ladies and gentlemen. This video is a continuation of our previous video where we looked at the cost of capital, in particular the cost of equity. Now, in this case, we are going to look at the cost of debt. The cost of debt is the estimate of the return debt lenders require. So what they expect in return for them giving us the money, that's the cost of debt. If the company is traded debt, we can determine this by using the valuation theory backwards, as we did when we were calculating the cost of equity. All right, where we say that initially we had the dividend valuation model that gave us the information about PO, okay, and PO was actually determined as the D over KE, if you still remember. All right, thus the market value of the share was the same as, or was equal to, the present value of the dividends. Okay, present value of the dividends discounted at the company's cost of equity. All right, so which is actually the present value of a perpetuity. In this case, the dividend was said to be constant. All right, now we can use the same logic in determining the cost of debt. Okay, for example, the cost of debt irredeemable. If the debt is irredeemable, just that is constant in perpetuity, then the KD would actually be the interest over the K, the cost of debt, the interest payment over the cost of debt. So, sorry. Sorry, this is the market value, rather. The market value, okay, of debt should actually be equal to the interest payments over the cost of debt. And we can as well determine by just making KD subject to the formula. We can say KD is therefore interest payment over the market value of debt. All right, so similarly here we can say KE is equal to D over PO. All right, but there is a problem. All right, the issue or the insurgence of taxation makes it a bit complicated because the difference between equity holders and debt holders is that while it's interest, the interest cost is tax deductible, the dividends are actually not tax deductible. So this makes the debt investors or the debt holders the ones at an advantage. Okay, so this is why normally debt is considered cheaper, because by the end of the day, the company that is going to pay tax is going to be allowed, to deduct the interest costs from its profits before they compute their taxation. So the interest payments are tax allowable, they are tax deductible, which means they make the cost of debt cheaper. All right, so that is what happens on the ground. Now let's move on to the terminologies that we are likely to meet. All right, the terms loan notes, bonds, loan stock, and marketable security or marketable debt are used interchangeably. Okay, marketable debt, loan stock, bonds, and loan. And then gilts are debts issued by the government. So you need to appreciate that these terms simply mean one and the same thing. They just refer to one and the same thing. The loan notes, the bonds, the loan stock, and marketable debt. Okay, but when you are talking of gilts, these are debts issued by the government. Then irredeemable debt. This is a debt where there is no repayment of the principal, and the interest is going to be paid in perpetuity. In perpetuity means to infinite, forever. Then redeemable debt. This is a debt where the interest is paid until redemption of the principal. So it is a debt for a fixed period of time, for a known period of time. Then convertible debt. This one may later be converted to equity at the discretion of the debt holder, or as allowed by the debt covenant. All right. Now, key points to note about debt. Okay, now the key points to note about debt. Debt is always quoted in $100 nominal value blocks. Sometimes in the exam, you can see the examiner saying debt is quoted at 95 cents. Okay, 95 cents, or you can see them saying at $95. All right, this means that the debt is going for 95 over 100. When you are valuing this debt, you just have to say 95 over 100, especially when you are seeing, not this one, when you are seeing it's being quoted at 95 cents, it simply means 95 over 100. So if the total debt is $1,000, then the market value, if the total debt in the books, the book value, okay, is said to be $1,000, all right, then the market value would be 95 over 100 multiplied by 1,000, and this means that this debt is 950. So that's $950 in market value terms. Okay, the market value is just the ruling value on the market. Okay, the ruling value on the market. Then interest paid on debt is stated as a percentage of nominal value called the coupon rate. Okay, so when you want to calculate the interest or the coupon rate, you don't use the market value, but you use the book value or the nominal value of the debt. That is, it should be based on $100. Okay, for example, the company has got 2 million loan stock or bonds, attracting an interest of 7%. If the interest is 7%, you're not going to base the computation on the market value, but rather on the $100 nominal. Okay, you would base this on the $100 nominal. So in this case, it will be $7 per bond. The interest payment will be $7. All right. Interest paid on debt is stated as a percentage of the nominal value called the coupon rate. The terms X interest and cum interest are used in much the same way as X div and cum div was for the cost of equity calculations. Okay. Now, we have got this information for an irredeemable debt, where the company does not intend to repay the principal, but to pay interest payments forever. So the assumptions are that the market price, that is the market value, is equal to the future expected income stream from the debenture discounted at the investor's required return, and we have already shown you that MV is equal to interest payment over KD, where I is the annual interest starting in 1 year's time, and then MV is the market price of the loan note now, that is year 0, and KD is the debt holder's required return pre-tax cost of debt expressed as a decimal. The required return, the pre-tax cost of debt, can be found by rearranging the formula. Okay, so this is the information. So we need to make some tax adjustments where appropriate. Okay, the post-tax cost of debt to the company is found by adjusting the formula to take account of the tax relief on the interest. So KD to the company or to the borrower is actually KD 1 minus T. It should be a post-tax cost of debt. Post-tax. This is to the borrower. So which means the interest I is going to be adjusted by 1 minus T. Okay, where T is the rate of corporation tax. The market value of the loan is set by the investor who does not get tax relief and is therefore based on the interest before tax. So to those guys who lend us money, they do not enjoy the tax relief we are allowed to enjoy as borrowers. All right, so according to them, the KD is a pre-tax KD. It is actually a pre-tax rate because they don't enjoy any tax benefit, so there's no tax adjustment to their rate. The company gets corporation tax relief, so the cost of debt calculation for the company is based on interest after tax. All right, that being said, let us do this particular example. When Euro PLC has in issue 8% irredeemable debentures quoted at 9% X interest, what is the return to the investor, that is KD, and what is the cost to the company if the rate of corporation tax is 30%? So this company, for A, we have to determine the cost to the investor. In this case, the investors, they are the ones who have borrowed us money. They are the lenders. So they don't enjoy the tax benefit. So the KD is not adjusted for tax. So we are going to have a KD is equal to 8%. That's the interest. So 8% of 100. Remember, it is 8% of 100, which means it's 8 over the market value now, because remember KD is equal to interest over market value. So the market value is now 90%. That is 90 over 100. Okay, which simply means as we have done, we have just say 8 over 100. Okay, is the same as 0.08, and 90 over 100 is the same as 0.9. Okay, so like and like, we can't say 8 over 0.9, is rather we say 0.08 over 0.9, okay, or 8 over 90. Are we together? That's the like and like situation I'm talking about. So in this case, our KD is equal to 8 over 90, that is 8.89%. Then part B, we are now looking at the cost of the debt to the company. So here we have to factor in the tax element because the company is allowed to enjoy tax relief. So the KD post-tax is equal to the same 8, the interest rate, okay, multiplied by 1 minus T, which is the T was 30% over the market value 90, which is equal to 6.22%. You can see that when taxation comes into play, the cost of debt becomes cheaper. Okay, the cost of debt becomes cheaper. All right, this 6.22 could also have been obtained if we just use this information here and simply say we need to just adjust this cost of the investor becomes multiplied by 1 minus T, and we get the same amount of 6.22%. So that's the same trick that is employed. Now let us look at this particular example and see as well if we can make sense out of everything. Cresta Baltico has irredeemable loan notes currently trading at $50 ex interest. The coupon rate is 8% and the rate of corporation tax is 30%. What is the return required by the debt providers? That is the pre-tax cost of debt. In the exam, the examiner is not going to tell you that the rate required by debt providers is going to be the pre-tax cost of debt. You just have to know that if the question says what is the return required by the debt provider, then tell yourself that this is the rate pre-tax, okay, the cost pre-tax of debt, cost of debt pre-tax. So we know that KD is equal to interest over market value. So what is the interest? The interest is 8% multiplied by the nominal value of the debt. The nominal value is $100. That's the nominal value of a debt. So interest is equal to 8 over the market value. The market value is 50 because it is quoted at 50. And this means that the cost of debt is 16%. What is the post-tax cost of debt to the company now, to the borrower? The borrower is going to enjoy tax benefits, okay? It's going to enjoy tax deductions on interest. So KD 1 minus T is equal to I 1 minus T over market value. So this means that there is 8 1 minus 0.3 over 50. which is going to be 11.2%. Okay, that is it. But what is the value of the irredeemable debt? Let us think of valuation, because by the end of the day, we are being driven to the concept of weighted average cost of capital, where we need to determine the market value of that financial source and its cost. Okay, so so far we have been cruising, and we were not I was not actually highlighting that intention. Okay, although when we're doing the dividend valuation model, you realize that we touched on the aspects of the market value of a share, which was PO. We said that PO in the dividend valuation model, the PO was actually the market value of a share. All right, the market value of a share. So this was actually a valuation idea. Now, when it comes to debt, we also have to think of the market values, and market values can be easily obtained. As you can see, you can just use this formula and make MV subject of the formula, and you get your market value. Okay, so let us determine the value of an irredeemable debt. So Justin PLC has in issue 500,000 10% irredeemable debentures. Investors currently require a return of 8%. What will be the market value of debt? All right, so we just use the same trick. We know that KD is equal to I over the interest over market value. So market value is equal to interest over KD, and our interest, the interest in this case is 8% multiplied by the interest is actually the 10%. All right, that's 10% of 100. That's okay, 10% of 100, that's $10 divided by KD. Okay, and this is the KD 8%, that is 0.08. And you can see that these guys, the debt is worth $125. That's the market value of the debt. Okay, now let's look at the cost of redeemable debt. Here, the company will pay interest for a number of years and then repay the principal, sometimes at a premium or a discount to the original loan amount. Okay, what do we mean when we are saying the debt is going to be repaid at a premium or at a discount? Okay, now if the debt is said to be repaid either at a premium or at a discount, we are simply saying the repayment would be above or below par. Okay, so for example, if it is going to be repaid at a premium, then the repayment is going to be done above the $100 nominal. Above $100 nominal. But if the repayment of the principal amount is going to be done below par, the par value, remember, is the 100, so it is going to be below $100 nominal. Okay, so please don't be confused with these terms. All right. Now, the assumptions which we should rely our computations on. Remember, the market price is equal to the future value, the future expected income stream from the loan note discounted at the investor's required return. All right, so that is the pre-tax cost of debt. Expected income stream would be in the form of interest paid to redemption and then the repayment of the principal. All right, but in the case of an irredeemable debt, then this component is not there because the debt is going to be not going to be repaid at any point in time. It is only a case of interest payments which are going to be made to infinity. Hence, the market value of redeemable loan notes is the sum of the present values of the interest and the redemption payment. Note that for the investor, the purchase is effectively a zero NPV project, as the present value of the income they receive in the future is exactly equivalent to the amount they invest today. The investor's required return is therefore the internal rate of return, the IRR, or the break-even discount rate for the investment in the loan notes. And by now you must know that the internal rate of return is that discount rate that gives us the NPV of 0. Okay, let us have a go at this example and see if we are mastering the concept. We have got a company called Gianni, right? Gianni PLC has in issue 6% debentures quoted at $85 ex-int. The debentures are redeemable in 5 years' time at a premium of 10%. So when we say at a premium, I said this means that the redemption is going to be above par value, and our par value is 100. So this redemption is going to be above 100. By how much? By 10%. So therefore, the redemption value is going to be 110. That's 110. Okay, $100 multiplied by 1.1. That's 110. Above that's $10 above the par value or nominal value. Okay. Now, what is the return to investors, KD? This is the pre-tax return. All right, and we have been told that the cost of redeemable debt, is equal to the IRR. All right, that rate which gives us the NPV of 0. Okay, so let us compute. So for us to determine the IRR, we need to use trial and error, because we just have to try various discount rates. So you start with one discount rate, just pick from Norway. Let's start discounting these cash flows at 10%, for example. So we are going to have an NPV table, and our NPV table is going to have years. Okay, the years, the cash flows, the discount factor at 10%. This is our first discount factor, and then we'll get the PVs. All right, and then we have got another discount factor. Okay, discount factor at we are not yet sure which percentage we are going to use. We will be led by the outcome. The first NPV is going to tell us which percentage shall we use. So year 0. In year 0, we have the market value of the debt or the bond. Okay, and the debenture is going for, remember the term debenture, bond, loan stock, etc. They just refer to one and the same thing. So in year 0, we have got 85, which is an outflow, the investment. Okay, and the discount factor for year 0 is always 1. Okay, and when you multiply, you get a PV of 85. Then you move on to years 1 to 5. Remember, this is going to be redeemable in 5 years time. So between years 1 and 5, we'll be paying interest. So in all the years 1 to 5, you'll be paying annual interest, and we are told that this is a 6% debenture. So we are paying 6% of $100 nominal, that is 6. Okay, 6 per annum. So the discount factor 10%, discount factor 10%, 5 years, that's an annuity. We need an annuity factor, and using the annuity tables, if you go to the annuity tables, 10% 5 years, you must get 3.791. Okay, 3.791. If you multiply by 6, you get 22.75. Then in year 5, we have a loan repayment, and we are going to repay at a premium of 10%, which means 10% of 100, that is $10, plus the nominal value of $100, that's 110. And we have to discount this by the discount factor 5 years from the present value tables, that's 0.621. Remember, these figures can be computed manually, and there was a video, I think on week 4, in which I was explaining the process of computing these present values. So please refer to that video for you to acquaint yourself with the techniques. So 110 multiplied by 0.621, we get 68.31. That is 6.07. So we have obtained an NPV that is positive. This is the NPV. Okay, now we need a discount rate that is going to give us a negative NPV. So in this case, since these discount factors were based on 10%, okay, then we need a much higher rate, because the higher the rate, the lower the NPV. So let us then try to use 15%. So discount factor 15% for year 0 is always 1. Year 0 is always 1. So we get our 85 negative. And then for 5 years, year 1 to 5, we need an annuity factor. So that's 3.352. And when we multiply by $6, we get 22.11. Then here for year 5, discount factor at 15%, that's 0.497 multiplied by 110, we get 54.67. So if we add up, we get negative 10.22. So let's now calculate the IRR. IRR is equal to lower percentage plus NPV lower over NPV lower minus NPV high percentage multiplied by higher percentage minus lower percentage. So the lower percentage was 10%, so the IRR should actually be somewhere there. 10% plus the NPV of the lower percentage was 6.07 over 6.07 minus the NPV of the higher percentage, which was minus 10.22. So 6.07 minus 10.02, this becomes 10.02. I mean 10.22. All right, multiply by 15% minus 10%. So this one gives 10% plus, if we use our calculators, 6.07 over 6.07 minus, it's now plus, so plus 10.22, that's 0.37, okay, 0.37262124 multiply by, here that's 5%, 15% minus 10%, that's 5%, so multiply by 0.05, or just say multiply by 5, so it's okay, we know it's a percentage, okay, so you get 1.8%, so this means 10% plus 1.8631062%, and this comes to 11.86% to 2 decimal places. Okay, that is it. So this is the answer to the first part. This is how we calculate our KD, the return to investors. What about the cost to the company if the rate of corporation tax is 30%? This is now the post-tax cost of debt, which is the cost of debt to the borrower. Okay, now let's do part B and see if we can catch something. Another point I forgot to mention was that during your trial, you just have to lead yourself by the principle. We know that the internal rate of return should be 0. Okay, the internal rate is the rate at which the NPV should be 0. Okay, so when you pick your first discount rate, if it gives you an amount that is closer to 0, for example 0.1, if the NPV is 0.1 or 0.5 or what, then it means that you can actually use that one as your cost of debt, okay, because in the exam there won't be any such time, so you would have been very lucky. You can just tell the examiner that, hey, this is a rate that is closer to 0, so that's the IRR. They will be happy if you can point out. They can be happy if you can point out to them that you understand what the IRR is all about. Okay, so for B now, we can just use the same table and create and determine our IRR. So that's the years. We've got years, we've got cash flows, we've got the discount factor at a certain percentage, then the PV. We leave a column for another discount factor and PV. discount factor at whatever percentage, and then we've got the PV. All right, and let me just try to use another pen. So in year 0, we've got our 85. Okay, so the discount factor as usual is 1 for year 0, and our PV will come as negative 85. Okay, all right, but now the first rate we can use, let's just start by 10%. All right, so from year 1 to 5 we are paying an interest, but now this interest is going to be tax adjusted. Remember, the interest rate was 6%. Okay, so 6% multiplied by 100, it gives us $6, but we need to adjust this one by the tax rate, so 1 minus t, and the tax rate, we are told that the tax rate is 30%. Okay, so we need to adjust our interest accordingly, so we are going to use the 30% rate here. So we're going to say 0.30. Okay, so 6 multiplied by 1 minus 30 is just the same as 6 multiplied by 0.7, which is equal to $4.20. So our interest is $4.20 per year, per annum. Okay, so the discount factor for the 5 years, year 1 to year 5, should be the same. Okay, that is 3,791 at 10%. All right, then if we multiply 4.2 by 3.791, we get 15.92. Then for the year 5, that's 110. Okay, and this one is discounted at 0.621, and this gives us 68.31. So if you add up these figures, you must get a negative 0. It's actually not a negative. That's not a negative, but rather it's a positive figure. 0.77. So as you can see, this value is nearer to 0. Nearer to 0. So we can safely say the cost of debt is equal to 10%, the discount factor which we have just used. Okay, so that's the cost of debt, because it is almost equivalent to the IRR. Okay, the IRR. So if you want to continue, you can actually put 11% or 12% on the other is the other discount rate, and you compute. Obviously, you're going to get an IRR of something like 10.1% or 10.2%. So we can safely say the cost of debt here is 10%. All right, that is it. So whenever in the exam you get in your first discount rate, you discover that the NPV here, the NPV is actually 0.77, or I mean 0 point something, then you can just use that one. You just have to advise the examiner that as the NPV is nearly zero, then we can safely say that's the internal rate of return for this particular date, and that's the cost of debt. Now let's talk of the valuation of debt. Okay, the value of the redeemable debt. How do we value it? Let us consider this example. Xpen PLC has in issue 400,000 8% debentures redeemable in 5 years' time at a premium of 10%. Investors require a return of 12% per annum. Calculate the market value of the debt. Now, I'm sure from the definition, the market value or the market price is the future expected income stream from the loan notes discounted at the required return, the investor's required return. And these include the interest payment as well as the repayment of the principal. So if we come to this last example, this example here, we can see that the market value was this one. Okay, so obviously this amount should be obtained after we add this one and this one. If we add this one, we should come to around 85, and this should actually be the market value. Why is it so? The idea is because we believe that the market value of the cost of a redeemable debt is its internal rate of return. So there is this statement: note that for the investor, the purchase is effectively a zero NPV project, as the present value of the income they receive in future is exactly equivalent to the amount they invest. So the amount that is invested is the market value of the debt. Okay, so it is equivalent to the future income they are going to receive. So this is why I'm saying that by the end of the day, to determine the market value is going to be an easy task, because we will be considering the present value of the interest payments as well as the present value of the redemption, okay, or of the capital amount, okay, or the principal amount. So let us create our NPV table. We've got years, cash flows, discount factor. Okay, in this case, we are told that this is 12%. So discount factor is 12%, and then the present values. Okay. So where is my calculator? All right. So this loan is going to be repaid in 5 years. So since we are calculating the market value, we do not know the market value. So the year zero amount is not there. So what we know is from year 1 to 5, we're going to pay interest, and the interest is 8% multiplied by 100. That's $8 per annum. And the discount factor, we are going to use a 5-year annuity at 12%, that is 3.605. So 8 multiplied by 3.605, 8 multiplied by 3.605, that's 28.84. And then in year 5, we are going to repay this one at a premium of 10%, so that's $10 above the nominal. Okay, then the discount factor there from present value tables. So obviously we are going to have 62.37. If we add up, we do not get the net present value this time, but the market value. So this is our market value, and if we add up, we are going to get 91.21. This is the X interest market value of the date. Okay, now on your own, just have a go at this problem. Slavangana PLC has in issue 1,007% debentures redeemable in 4 years' time at par. Investors require a return of 10% per annum. Calculate the market value of the date. Okay, so in this case, we just follow the same steps as we did. We have got our years, we've got the cash flows, we've got the discount factor at how much? 10%, because that's what we are told. And then we've got the present values. So for year 1 to year, how many years? 4 years. So to year 4, the cash flows, that's 7% multiplied by 100. That's $7. So that's $7 per annum. All right, and the discount factor, the annuity factor, 10%, 4 years, that's 3.170. You can obtain this figure from the annuity tables and multiply by 7, that's 22.19. And then for year 4, that's the capital repayment. Okay, and this one is going to be redeemed at par, that is $800 nominal. Okay, and the discount factor that year would be 0.683, so that's 6830. If you add up, you get the market value of debt, that is 90.49. Okay, X int. All right, now there is a situation when the debt is going to be redeemable at current market price. In this situation, where the debt is redeemable at its current market price, the position of the investor is the same as a holder of irredeemable debt. Therefore, where the debt is redeemable at its current market price, you just have to use the formula KD is equal to interest over market value. And if the examiner wants you to calculate the KD in the eyes or in the hands of the borrower, you then have to use this one. This one is in the hands of investor or lender, but this one is in the hands of the borrower or company. Okay, please watch out. Now let's talk of this special date, the convertible debt. We say that this is a debt that can be converted into equity in the near future. So there are some steps you need to follow to calculate the cost of convertible debt. The first thing, you have to calculate the value of the conversion option using available data, and then compare the conversion option with the cash option. Assume all investors will choose the option with the higher value, and then calculate the internal rate of return of the flows as for redeemable debt. Please note that there is no tax effect whichever option is chosen at the conversion date. So let us have a look at Tarino PLC. Tarino PLC has issued convertible loan notes which are due to be redeemed at a 5% premium in 5 years' time. The coupon rate is 8% and the current market value is $85. Alternatively, the investor can choose to convert each loan note into 20 shares in 5 years' time. The company pays tax at 30% per annum. The company's shares are currently worth $4 million and their value is expected to grow at a rate of 7% per annum. Find the post-tax cost of convertible debt to the company. All right, so the first step is to compare the redemption value with the value of the conversion. All right, so the first step number one, compare the redemption value, RV, okay, with the value of the conversion option. All right, so redemption value, that's the cash redemption value. This one is going to be redeemed at what? The coupon rate is 8%, all right, due to be redeemed at 5% premium. Okay, there is a 5% premium, so which means the redemption value is going to be $100 nominal multiplied by 1.05, and which means that's 105. All right, so we are going to have, per each block of 100, we are going to get $105. But if we convert to shares, then we are going to get how much? The loan note into 20 shares. All right, and the company shares are currently worth $4. All right, and these shares are expected to grow at a rate of 7% per annum, and we are looking at how many years? 5 years time. So we're going to say $20, I mean not $20 actually, but 20 shares, because we're going to have 20 shares. Each loan note is going to give us 20 shares, so that's 20 shares multiplied by the share price, which is $4. I'm sure, yes, $4, and it is growing at 7%, so that's 1 plus G, that is 7%, so 1 plus 0.7, that is 0.7 for 5 years. Remember, the growth is going to happen for 5 years. All right, and this should actually give us 20 multiplied by 5.61, which is equal to 112.20. So the second step now is we need to select, okay, the highest of the two values, that was of 105 and 112, of the two values as the amount to be received in year Tn. So the general assumption is that the investors will choose to convert the debenture and will be, because the conversion value, remember the conversion value is giving us, the assumption is that they will choose to convert the debenture, and this will therefore they will therefore receive $112.20. All right. So, however, in the exam, you actually need to determine from the facts in the scenario whether there is a high likelihood that conversion is likely going to take place. All right. You need to, because the examiner might actually say, but given the culture of these investors, the probability that the conversion is going to take place is 0. Then obviously you then have to value that bond based on the smaller amount, that is the cash amount. Okay, where you had determined that the cash amount was lower, as in this case, but you're also told that the likelihood of conversion is the same as 0, then you have no option but just to resort to the cash value, the redemption value. However, all things being constant, you then have to follow this procedure where you just have to pick the highest amount. All right, now once we have done that, let us then do our NPV table as usual. Let us do the NPV. Okay, so let us now do the NPV table as usual. Now, table is like this. Okay, remember we need to follow the redeemable debt procedure where we calculate the IRR. So this is just the same procedure. We've got years, cash flows. Okay, the cash flows. These cash flows, please do not mix them. They've got names. All right, so let me just say cash flows and then amounts, so that in the cash flow column I will be explaining these cash flows. And then the discount factor at say 10%. Okay, 10%. I just love 10% to start with 10%, but it is not a rule that you must always start with 10%. That's not the rule. All right, so year 0, the market value. Okay, the market value. All right. Okay, what was the market value of the date from the question? The market value was $85. Okay, was 85. And this is given in negative, and the discount factor for year 0 is always 1. Obviously, we get a negative 85. Then years 1, how many years are we talking about here? That's 5 years. So that's 1 to 5, year 1 to 5. The interest is it was 80%. Interest rate is the same as coupon rate. So 8% of $100 nominal, that's $80. Okay, so the interest payments, we are talking of $8. All right. However, we need to adjust the tax because we are given the tax rate, and you can't afford to ignore the tax rate in the exam. So that we need to adjust by 1 minus t, that is multiplied by 1 minus t, that is 0.7. Okay, so you can do your adjustment here and say 8 multiplied by 1 minus 0.30, and this gives you $5.60. Okay, to consult the discount factors, the annuity tables, because this one is an annuity, and because the interest is being paid per annum, so this is an annuity, and the discount factor for 10 years, 5 years, the annuity factor 10 years, 5 years, that's 3.791. So if you multiply by 560, we get 21.23. And then in year 5, we have to discount the redemption value, but in this case, it is the conversion value. Conversion, because we have chosen the conversion value. And these are going to be converted at 112.20. All right, and the discount factor there is 0.621, and we get 69.68. That is 112.2 multiplied by 0.621. So if we add up, we must get the net present value. Our NPV should be 5.91. So this one is a positive NPV at 10%. So for us to get a negative NPV, we can simply use a discount factor that is higher than 10%. Okay, but it's not a big deal at this level, because you can as well use any other percentage which you want. Let us say you used 5%. Obviously, the NPV you're going to get is going to be higher, because the lower discount rate is going to give you the higher net present value. So let us use an even lower discount rate. So in this case, we're going to use the 5%. Discount factor at 5%. Don't worry. Of course, in our first example, we had used a higher rate so that we get a negative NPV, but right now we just want to get a positive NPV. So don't worry. PV. Obviously, in year 1, the 85 just comes. In year 0, the discount factor is always going to be 1. And then for years 1 to 5, the discount factor, the annuity factor 5% is going to be 4.329, and if we multiply by 560, we get 24.24. And then here we'll be using a discount factor at 5%, and this is going to be 0.784. And we get 87.96. So if we add up, we get a total of 27.2. So obviously, we are having both positive NPVs. In this case, what we do is just to follow the same formula as we use. We say that IRR is going to be lower percentage plus NPV lower, the NPV at the lower rate, over NPV at the lower rate minus NPV at higher rate, multiplied by higher rate minus lower rate. So that's the formula. So we come down here and say IRR is therefore the lower rate is the 5%. Remember, in this case, the lower rate is the 5% plus the NPV at the lower rate. NPV at the lower rate was this one, so 27.20 over 27.20 minus the NPV at higher rate 5.91 minus the higher rate 10% minus the lower rate, which is 5%. Okay, and you must get, if you solve everything here, you must get your 11.4%. So you mustn't stress up. You mustn't stress up if whatever figure which you have used has all given you negative NPVs or have all given you positive NPVs. You are still going to calculate your internal rate of return. So does it mean that because we are saying the internal rate of return is the rate at which the NPV is going to be zero? So if we use this NPV, if we use this rate, are we really going to get a negative, a zero NPV? The answer is yes. Just try it on your own. Okay, you just have to, instead of using the 10% discount rate here, you can just use the 11%. Obviously, if you use the 11.4%, you are going to get an NPV of zero using these cash flows. All right, that is it, ladies and gentlemen. Let us talk of all right, I used to have this example which I feel if you guys attempt this one on your own, you can benefit a lot from this lecture. Okay, now let's do it together. Blessing PLC has in issue 8% debentures 2020. On maturity, the debentures may be redeemed at par or converted to 20 ordinary shares in the company for every $100 nominal. The share price is currently $4.50 per share, and this is expected to grow at 7% per annum. If now is the end of 2017, investors require a return of 10%. Calculate the market value of the debt and calculate the conversion premium. This is actually a very interesting question because it takes us to another dimension where we discuss of the conversion premium. All right, the conversion premium. Now, let us do the computations. Okay, basically when we are talking of the conversion premium, this is the amount, okay, amount by which the price of a convertible security, exceeds the current market value of the common stock into which it may be converted. Okay, so this is actually the precise definition of a conversion premium, which is the amount by which the price of a convertible security exceeds the current market value of the common stock into which it may be converted. So, in short, we are simply saying this is the added value that a convertible security possesses due to its conversion option. the added value of the conversion. Okay, so let us see how these definitions would make sense. All right, so let us first calculate the market value of the date. All right, where is the drawing board? Okay, so remember this is a convertible debt, so let us first determine the value of the shares. Okay, remember this the redeemable debt itself is going to be redeemed at what? We need to match the value, the two values as we did initially. Okay, to match the redemption value and the conversion value. So we are told that the value, the debentures will be redeemed at par. So redemption value, what's happening to my pen? Redemption value RV is going to be $100 because they are going to be redeemed at par, but the conversion value is going to be how many shares? 20 ordinary shares. So that's 20 multiplied by the share price. Then the share price currently is 450, but it is growing at 7%, and this is up to how many years? That is, we are told that they are going to be redeemed in 2020. Okay, and today is 2017. All right, so we are talking of a 3-year lifespan. Okay, that's today is 2017. Okay, and redemption is in 2020. So 2018, that's 1, 2019, 2, 2023. So we are looking at 3 years. So obviously we come here and say multiply by $4.50, which is the current market price, and then the growth rate. The growth rate is actually going to be multiplied by 1.07 to the power 3. Okay, and this shall give us about $110. So shall we choose this value or this one? Obviously we are going to choose conversion. Therefore the conversion value is going to be chosen. Now that we have determined that the conversion value is to be chosen, we come to our NPV table. Yes, cash flow, discount factor. Remember, we are calculating the IRR of the project. Okay, we are calculating the IRR of the project. All right, so discount factor, and okay, I think I missed one thing here. What is required is actually the market value of the debt. So in terms of the IRR, there's no point because we have been given the rate already. So we just need to calculate the market value of the debt. So in that case, the job has been made simpler. So the discount rate is 10% here, then our PV. So we do not want to calculate, we do have to calculate the market value. So what we have are the interest payments, okay, 1 to 3 years. The interest is going to be interest. Remember this one, in this question, the taxation is not involved. So the interest is, we are told it is an 8% debenture. So 8 multiplied by 100, that's $8. So the interest is 8, okay, per annum, $8 per annum, and then the redemption value. This time we are using the conversion value in year 3. The conversion value, we determine it to be 110. Sorry, 110. Okay, so what happens is the discount factor 10 years is actually going to be an annuity factor 10 years, 3 years, and this is going to be 2.487 because the interest payments are going to be paid per annum. All right, and then we have to discount this amount 10% 3 years, that's 0.751. So 8 multiplied by 2.487, we're going to get 1990. And then 110 multiplied by 0.751, we're going to get 82.61. And if we add these figures up, we get our market value. So the market value is going to be 102.51. So we are done. And then the conversion premium, we said this is the amount by which the price of a convertible security exceeds the current market value, current market value of the common stock. So the current market value, we are told that this is $4.50. All right, and the price of this security, the price of the security is 102.51. So let's determine, we can just say the price is actually 102.51. Okay, that's the market value from our computation, right? But this is the market value in 2020. Okay, so that's the market value, and then the current price, okay, the current share price was actually how much? All right, the current share price was $4.50. All right, $4.50, and this the arrangement was that we were going to get 20 shares. So 20 shares multiplied by $4.50. Current price was 20 shares multiplied by $4.50. So obviously here we are going to get 690. Yes, 90. So the conversion premium CP is actually going to be 12.41. I mean 51. That's the conversion premium. If we are to convert, then we are going to be better off by $12.51 for every $100 bond. All right. Okay. No need actually. Because it should be like and like, so the market value is actually the market value today, that is 2017, not 2020, versus the current market price of a share. This is the market value of the bond, remember, but this one is the market value of the shares. Okay, this is MV of shares or equity. Okay, 2017. All right, that is that. Now, you might also be given the non-tradable debt as part of your cost of capital. You have to be able to treat or to determine the cost of the debt to the company. So if you are given a non-traded debt, okay, then you just have to multiply the debt's interest by the tax rate. I mean, you just have to adjust this interest rate by the 1 minus tax rate is given here. So non-tradable debt includes bank and other non-tradable fixed interest loans simply needed, which you would have acquired from the bank. So you simply need this adjustment where if the interest rate on that date is 8%, then KD given the rate of tax of 30%, then KD would be 8% multiplied by 1 minus 30%, and this means 8% multiplied by 0.7, and you are going to get 560. Remember, 8% is 8 multiplied by 100. That is $80. So $80. Excuse me. I'm sorry. Okay. This simply means that if the rate of interest is 8%, here we are not looking at monetary, but the cost of capital. Okay. So the 8% is going to be multiplied by the tax adjustment, that is 1 minus 30%, and you are going to get 5.6% as the after-tax cost of debt. Okay, that's it for the non-tradable debt. Remember, this one is non-traded, and usually the book value given are going to be used as your market, as your values when you are calculating the weighted average cost of capital. Okay, so the value of the debt is actually the given value, or the book value usually, because it is actually difficult to come up with a market value because this type of debt is not going to be traded. Okay, it is not traded. All right, let us look at this particular example and see. A firm has a fixed rate bank loan of 1 million. It is charged 11%, and the corporation tax rate is 30%. What is the post-tax cost of the loan? And we say that this should be interest. The interest multiplied by 1 minus T. So the interest in this case is 11%. 11% multiplied by 100. Okay, if you want to get the amount they are paying $11. However, this one is not what is required. What is required is just the cost of the debt. So you simply have to say 11% multiplied by 1 minus 0.03. Sorry, 0.30. Now an issue of inertia. Okay, and that's 11% multiplied by 0.7, and this one is going to be 7.7%. Okay, that's the idea. Now let's talk of the cost of preference shares. The cost of preference shares can be, can follow the formula of an irredeemable debt. Okay, we just use the same principles which we did when we were using the irredeemable debt, or when we're calculating KE, where the dividend is constant. So in this case, the KP dividend is usually fixed. It's a fixed dividend which is to be paid, right? So usually there is a constant dividend, so D over PO, and the market value of the preference shares is actually going to be a rearrangement of the formula, as you can see here. So this is the KP, the cost of the preference shares. So this example is actually going to be very useful. Zexco has 50,000 8% preference shares in issue, nominal value $. The current active market value is $20 per share. What is the cost of Zexco? I'm sorry, I just want to plug in the power because the machine is starting to misbehave. Okay, just looking for that port. So that we won't run out of power. Okay, so we know that KP is equal to D over PO. That's what we know. All right, so sorry, KP, not KD. KP. Therefore, KP should be, now the dividends is actually going to be based on the 8%. Okay, so 8% of the nominal dollar value. Okay, so that's 8% multiplied by 8% multiplied by $1. By $1, we're going to have 8. Okay, we're going to have 8. All right, or 0.08. That's the idea. Okay, so this is actually going to be 8 cents. All right, so the 8 there simply means the 8 cents. All right, so that's 8 over the market value. The market value of the ex dividend market value of the preference shares was $20, which is the PO. And I said you just have to use the like and like. Since we are using the cents, so obviously $20 is equal to 120 cents. So we are going to say 8 over 120, and we get the cost of preference shares as 0.0667, which is equal to 6.67%. Okay, that's the idea. Now, once you have mastered all the costs of capital, okay, all the cost of capital, you then have to move on to what is called the weighted average cost of capital. The firm's weighted average cost of capital represents its blended cost of capital across all sources, including common shares, preferred shares, and debt. That is according to the Corporate Finance Institute. The computed Wacc, remember Wacc stands for weighted average cost of capital. So the computed Wacc represents the cost of the capital currently employed. This represents the financial decisions taken in previous periods. Alternatively, the cost of raising the next increment of capital can be determined. This is what is termed the marginal cost of capital, the MCC. The firm's MCC is the additional cost the firm will pay to raise an additional dollar of capital, assuming the capital is raised using the optimum capital proportion. Okay, you don't have to see a section on the capital structure. On capital structure 2, we're going to touch on that section in the next video. The cost of each type of capital is weighted by its percentage of total capital and they are added together. So in the case of the Wacc, we are saying the cost of each type of capital is weighted by its percentage of the total capital and they are then added together. So the weights for the sources of finance could be book value, which represents the historic cost of finance, or market value, which represents the current opportunity cost of finance. Wherever possible, you just have to use market values in computing the weighted average cost of capital. So for us to see what is happening, let us see this formula. This is actually the formula which you are going to use whenever you do your computation. And this formula is given in the exam, so do not crack your head trying to cram it. Where so the work is equal to VE over VE plus VD multiplied by KE plus VD over VE plus VD multiplied by KD minus, multiplied by 1 minus T. VE and VD are the market values of equity and debt respectively. KE is the cost of equity and KD 1 minus T is the post-tax cost of debt. So let us look at this example before we conclude the lecture. These are just the steps which we have to use in the calculation of the work, where we are saying that step number 1, you need to calculate the weights for each source of capital and then estimate the cost of each source of capital and then multiply proportion of total of each source of capital by cost of that source of capital. Then sum the results of step 3 to give you the work. Okay, now we've got this example which we need to master. AGB PLC is financed as follows: equity $5 million, $1 shares quoted at $2.50 cum div, on which a constant dividend of 32 cents per share is about to be paid. Then debt is 4 million, 8% debentures quoted at 92x int. Corporation tax is 30%. Calculate the returns to investors on equity and on debt, and then calculate the work to the company. So in this case, our work is very simple. For part A, the cost of equity, KE, we can use the dividend valuation model, okay, which says that if you use the dividend valuation model, in this case, we need to determine if the dividend is growing or not, okay, and equity $5 million, $1 shares quoted at $2.50 cum div, on which a constant dividend of 32% of 32 cents per share is about to be paid. So this one is actually the formula where we are saying KE is equal to D over PO, because it is a constant dividend. All right, constant dividend that is not growing, that is just like that, fixed. So we need then to determine the dividend is not going to change. It will remain at 32. So in terms of dividend is 32, but PO, we are given the cum div, that is before the dividend. So we need to adjust this one to be 250 minus the dividend of 32, and then we get our the KE the XDiv KE. Okay, the XDiv price is to be used. All right, so the KE is going to be 14.68%. Now, what about the cost of debt? The cost of debt KD is going to be used. This one, 4 million 8% debentures cost quoted at 92x int. This one's now, this is an irredeemable debt because we are not told when we are going to repay the principal or when we are going to redeem the debt. So the assumption is that the debt is irredeemable. So cost of irredeemable debt is 1 over market value. Interest over market value. This is not 1, it's interest over market value. And the interest here cannot be adjusted because remember we are still on part A where we are looking at the returns to investors on equity and on debt. So we are looking at the pre-tax cost of debt because that's the rate which is required by investors. They do not enjoy tax deductibility of debt. So we're going to say the interest was 8% multiplied by 100, that's $80 over the market value. This debt is quoted at 92. So over 92. So obviously the debt is $8. I mean 8.70%. Now let's move on to part B where we are required to calculate the Wacc. Now when we are required to calculate the Wacc, in this case now we are looking at the cost of capitals in the hands of the company, of the borrower. So we need to adjust the cost of debt wherever possible with the tax rate. So for the cost of capitals, the cost of equity, we're going to say this one cannot change because of taxation. Okay, the cost of equity will just be the same as we have determined here. So we are going to use 14.68%, but the KD is going to be adjusted. It's going to be tax adjusted, right? We had determined KD as 8.70. We then have to multiply by 1 minus T, which is minus 0.30. Okay, and we must get our KD as 6.09%. Now, for the Wacc is equal to, we then have to use the proportions. We have to use the proportions. Remember our KE, remember from the formula, we are given that Wacc is about VE over VE plus VD multiplied by KE plus VD over VE plus VD, okay, multiplied by KD 1 minus T. So in this case, the value of equity has to be determined. Okay, we need to determine the market value of equity and market value of debt. Now, market value of equity. Market value of equity the PO, our PO, remember, the PO, this PO was actually this amount, 250 minus 32. That's $2.18. So $2.18. That's the market value of a share, $2.18 or 218 cents. All right, multiply by how many shares? 5 million shares. So that means 2.18 multiplied by 5, that's 10.9 million. And then market value of debt, we are told that the debt is quoted at 9.2. So that's 992. Okay, 92 over 100 multiplied by 4 million. $92 over 100 multiplied by 4 million is equal to 3.68. So if we, okay, I want you to see something. Market value of equity in our formula is just equal to VE. Market value of debt in that formula is equal to VD. All right, then VD plus VE, we get the total. So let us see the total. 3.68 plus 10.9, that's 14.58. So the total is 14.58 million. All right, so to slot these figures in the above formula, we now say, therefore Wacc is equal to, in the first bracket, that's VE over VE plus VD, that's VE or VE is this one, 10.9, okay, over 10.9 plus VD, 3.68. And the cost of equity, we had determined the cost of equity as 14.68. So multiply by 14.68. You can just put these figures in decimals if you wish. You can just put them in percentages if you wish. Okay, but if you just have to know, like for example, if I simply say 14.68, I know in my mind that it is a percentage, that 14.68 is a percentage. So whatever figure I'll obtain, I'll simply put the percentage at the end. All right, plus, so this is there's a multiplication sign there, then plus VD, the VD is 3.68 all over 10.9 plus 3.68. Okay, multiplied by the cost of debt, KD. The KD was 6.09. Now the question that comes is, shall we multiply this KD again by 1 minus T? Because in the formula it is written 1 minus T. No way. You do not repeat again the adjustment, because the adjustment has already been done. So at this point, you need not to do the adjustment again. You leave it, the 6.09 as it is. Then you must get your Wacc as 12.51%. Okay, the Wacc has been is a cost of capital that is a bit lower than the cost of equity in general. That's what normally happens. You can see that the cost of equity was 14.68, but because we are considering a cost of capital that is weighted against a cheaper cost of capital, that is the cost of debt is cheaper, then by the end of the day, the overall cost of capital should actually be lower. This is the 12.51%. All right, much on that in the next video, where we'll be looking further at these assumptions. Please also note that the Wacc can be calculated. The cost of debt, all the cost of capital could be considered in a Wacc question. All right, the cost of debt could be irredeemable or redeemable, could be the debt could be irredeemable or could be convertible. It could be preference shares, could be anything. You just have to extend this bracket, can be extended to accommodate all the cost of capitals that are involved. So do not say that I was not told. Okay, there are examples for redeemable dates which are in your notes. Just follow those examples and see what would be going on. Okay, now there is this important point I want to highlight concerning the instances when you should use the weighted average cost of capital, because in your discursive parts, in discursive parts of your exam questions, you might be asked, when shall you use the Wacc, what would have happened, and so forth. You need to be in a position to pinpoint when you should use the weighted average cost of capital. You can't afford to miss a mark on that type of a question. Okay, so we have already pointed out that the Wacc calculation is based upon the firm's current cost of equity and debt. The Wacc is therefore appropriate for use in investment appraisal provided the historic proportions of debt and equity are not going to be changed, and the operating risk of the firm will not be altered significantly, and then the finance is not project specific. The projects are financed from a pool of funds. And lastly, the project is more in relation to the company, so any changes are insignificant. Otherwise, it will not be appropriate to appraise a project using the historic work. So these are the conditions which should exist for you to use the Wacc as a project appraisal discount rate. All right, I hope you have benefited a lot, and please don't forget to subscribe, to share, to like the video, so that you would be doing the right thing. So I want to see you, ladies and gentlemen, in our next video in this week 6 lecture series, where we'll be looking at the optimal capital structure, and hopefully in the Kappa model, because we need to discuss further the Kappa model. All right, so until then, ladies and gentlemen, may you continue to just feel rejuvenated and happy. All right, I, the Acca tutor, I am signing out. Bye.